via long commodities, long high yield bonds, long international stocks, long emerging markets, so long as US dollar peaks, as well as old economy cyclical sectors. The long and short of it is this is confirmation to him that the boom part of the clock is in play.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Hello, everyone. This is the Hardnet Flow Show entitled Deep Peak. Housekeeping. Good afternoon. Hardnet's weekly report is presented two ways. Video walkthrough with commentary, which we're doing right now. A visual of the PDF while we're doing it, the full PDF. And the second way, Hardnet's main points will be broken out on the right below, along with pictures contiguously placed. So let's start. Scores on the doors: crypto 7.8%, gold 7.1%, stocks 3.8%, commodities 3.5%, oil 1.8%, high yield bonds 1.3%, investment grade bonds 0.8%, government bonds 0.7%, cash 0.3%, and the US dollar down 0.3% year to date. Tail of the tape: monetary easing is peaking. Global central bank rate cuts in 24 equaled 164 versus 32 hikes. That's in table 1. Thus far in 25, we've had 10 cuts versus 3 hikes. The pace of policy rate cuts has peaked. Chart 3, we'll put that up in a second. Investors should position for a flatter yield curve going forward. A flatter yield curve can be bear flattening or bull flattening. Bear flattening would be if the yield curve flattens from the front end going up. So if short-term rates go up, that's bearish for stocks. A yield curve flattening could be bullish for stocks from the back end coming down. QE will be an example of that. He's not saying which it is, and he's probably smart not to, given that the Fed eased and we got a steeper yield curve. So the market is now looking at yields in a if not then. So if we don't stop inflation now, we'll have to fight it later. Let's see if he gets into that in more depth. The gist of this is one of the main points he's going to make. Why don't we just say his main points so you can get some framework on this? Right. He believes U.S. stocks are at or near their peak. He believes rate cuts are at or near their peak, at least the momentum of their cuts, as you can see in that picture there. He's very focused on PMIs in the sense that Purchasing Manager Index is an indicator of economic or economies heating up, and he believes that they're at a trough. So it would seem that the easy money is going to back off, not just here, but in other places as well. That said, the U.S. will be far tighter than other countries. He actually, his new term is, instead of the Magnificent Seven, it could be the Lagnificent Seven. He's refocusing on playing long internationals. For about a week there, he was thinking that we would have a broadening of the market domestically, but he didn't really recommend it. He has a clock, if you remember, he had a clock that described where we are, that we were leaving a recovery area and we were in a boom area. And it sounds like he's saying that we're still in the boom. We're in the boom. And that the boom is now going despite the fact that the central bankers, at least in the U.S., are not going to be easing much anytime soon. I do note that he's not mentioning bonds at all here. Although he doesn't say anything negative about them, I wonder. That's pretty much your framework. That's where he's going with this. And if you're thinking about this from a gold perspective, he doesn't mention gold at all, but he's as bullish, if not more bullish, on commodities than ever. and he still believes that the dollar is going to weaken. He does give a level that he thinks the dollar gets below and stays below a certain level. Then he thinks all bets are off and commodities could really boom as stocks, potentially rally, but not like they usually do. All right, moving on. The price is right. Manufacturing is troughing. US ISM global PMI to rise from 45 to 50, 2-year contraction range to 50, 52 expansion range in Q1 2025. In English, he's saying we're in a trough of 45 to 50, and that 2-year contraction range should reach out to a 50 to 55 expansion range in Q1 25. To trade the trough PMI, meaning the bottoming PMI, it's best traded via long commodities. There's your boom. Long high yield bonds. High yield bonds are like equities on steroids. Long international stocks. There you go, especially Japan and Europe banks. Long old economy cyclicals, e.g. materials. Long EM, emerging markets, if the DXY index breaks less than 105. Use U.S. tariff noise in Q1 for entry points into trough PMI plays. Starting on the back end, which is the actionable advice, he's essentially saying that tariff talk is globally recessionary. And he believes, at least to an extent, that much of this is noise in Q1, and use those dips as entry points into trough PMI plays. And again, the trough PMI plays are long commodities. So he's basically saying buy dips in commodities, right? Long high yield bonds. I wouldn't add a comment on that. Long international stocks, especially Japan and Europe banks. He gets into that in a little bit. Long old economy cyclicals. Sounds like a rotation domestically into energy and materials and copper, things like that. Companies. Long emerging markets if the dollar index gets below 105. Now, in emerging markets, he means all the BRICS, but I really think he's focusing heavily on China here because he thinks they're not done their stimulus yet. And in fact, I think that's one of his specific plays. All right, the biggest picture. U.S. exceptionalism is peaking. This is the piece. This is where he puts it together. U.S. exceptionalism is peaking. The tailwinds of excess U.S. fiscal spending and immigration and the AI capex bubble are fading. Investors are all in on U.S. exceptionalism, missing new secular bulls in cheap, unloved Japan and Europe banks. Areas where value outperforming growth stocks. Charts 2 and 6. We'll show those in a second. Note Japan banks still 74% below 1980 highs. Chart 4. EU banks are 67% below 2007 highs. Chart 5. And both are breaking with upside likely in our view. All right, so the charts are going to corroborate his math. The charts are not the reason he's doing it. But he is saying that U.S. exceptionalism has blinded money to going into Japan and European banks, and they have crept into a bull market without many people noticing it. And there's plenty of upside for them to go in it. He doesn't mention China here, but he does mention them later on. All right. Let's pull the charts up, right? These are a little small here. But the left is chart 2. U.S. growth is driven by tech. Japanese value has been driven by banks. So basically, he's saying Japanese value is outperforming tech over there. And over here, our tech is outperforming value. So the dark blue line on the left-hand chart is U.S. growth versus value stocks. The light blue line is Japanese growth versus their value stocks, or banks, when you think about it. Banks are value stocks. On the right is the same concept in Europe. Europe value stocks are outperforming their growth stocks. So there's the U.S. chart again. And below that in blue is you have the European tech underperforming relative to their own value. Next chart. He says Japanese banks are now in a secular bull market. If you look at that, a technician would call it a rounding bottom. That's your left chart. And on the right chart, there are probably various wedges you can draw that have been broken, but they're down 74% since 1989. That's what the left chart says. And on the right-hand chart, they're down, looks like 67% since 2007. So all in, he's saying he's got his contrarian shoes on in a big way now. He's saying that the market is very oversold and underpricing in the upside, that people are missing the boat in the US because of their profits in tech. I wrote some notes. Let me just read them to you. Skip bonds, go to inflation problems. Right. He's not saying to buy bonds in this one. Buy emerging markets is back in focus if inflation fighting is now. Right. Okay. And on the equity side, he's very equity contrarian, meaning get out of the US and go contrarian style. Right. Moving on to weekly flows. 24 billion to equities, 17.6 billion to bonds, 0.5 billion to gold, 0.2 billion to crypto, 12.6 billion from cash. Money is flowing into US ETFs, into GLD and SLV again. That's encouraging because the dollar has been nothing but, relatively speaking, strong. So it looks like, quick comment, even though he's not talking about it, I will. It looks like the Trump election hangover is done. The question is, are people buying the ETFs because of the tariffs? I don't know if the American investor is that savvy. So there you have it. Flows to know. High yield bonds, biggest inflow in 3 months. Emerging market debt, biggest inflow since 23. Here, I'll throw a couple of those charts up. Oh, chart 12. Wait. Does he even talk about that? Chart 12 is U.S. border encounters in 2024 were low, meaning in Q4 2024, we didn't even bother checking in. We just let them in. So who knows? People stopped coming to the border. Let's put it that way. Flows to know, high yield bonds, biggest inflow in 3 months. That's chart 13 on the right. Emerging market debt, biggest inflow since January 23. I'm not sure how to take that. That's chart 14 on the left. Tech, biggest inflow in 3 months. There's always money flowing into tech. So, he's contrarian, but nothing's giving them yet. Although, could be around the corner. Financials, biggest inflow since January 22. That's chart 15. You can see the financials. That's the light blue line over there. That's significant, right? Financials are cyclical. Financials are counter to tech. So maybe he's on to something. Year-to-date flows to know. Cash, money market funds, record Jan inflow, 174 billion. Treasuries, record Jan inflow, 17 billion. Global stocks, biggest Jan inflow. U.S. stocks, record Jan inflow. U.S. large cap stocks, record Jan inflow. Emerging market stocks, January outflow. It's interesting. If you look at the stock portion of this, that's your tariff conversation. Oh, we don't need to own emerging market stocks. Tariffs are going to kill them, right? I mean, I think the word is if we were to hit, coming out of Goldman was, if we were to hit Mexico, which I think we did, with a 25% tariff, it would push them into recession almost immediately. All right, see what's next. All right. B of A clients, B of A private clients, B of A bull indicator, up to 4.2 from 4.0 in inflows to high beta emerging markets and high yield bonds, tight credit spreads, and bullish hedge fund positioning. Okay, so we're still in the we don't care section of this. It's just updated. All right. Trough PMIs, Trough International, peak US exceptionalism. That's the main area for discussion. And I think he has an awful lot of charts tied to that today. He's very PMI oriented. So let's do that now. Trough PMIs, US and global manufacturing, new orders rising relative to inventories. Chart 8 on the right. Inventory shipment ratios lead PMIs and indicate US ISM rises from 49 to 52 or 53, corroborated by US regional ISMs in chart 9. All right, so let's stop there for a second. New orders and inventories are pointing to upside in global PMI. So people are putting in orders to buy stuff or to get stuff made, buy raw materials to make stuff. Okay. Uh, Inventory shipment ratios lead PMIs. We don't see that, but we have no doubt that that's true. Chart 9. Regionally speaking, PMIs are already turning, right? So regionals report earlier, and they're not officially organized federal numbers, but he's synthesizing them. And he's saying it looks good. Okay. Restarting. U.S. and global manufacturing new orders rising relative to inventories, chart 8. Inventory shipment ratios lead PMIs and indicate U.S. ISM to rise from 49 to 52, 53, corroborated by U.S. regional ISMs in chart 9 on your screen. And global PMI to move above boom-bust 50 level in Q1. Global manufacturing expansion after 2 years in doldrums, discounted by some cyclicals. See outperformance of U.S. industrials versus consumer staples in U.S. chart 7. I don't think this is a main point for us, but certainly is an interesting chart. But investors should position for Trough PMI theme via long commodities. Here's the part that matters. Investors should position for Trough PMI theme via long commodities, long high-yield bonds, long international stocks, long emerging markets, so long as U.S. dollar peaks, as well as old economy cyclical sectors, e.g. materials. The long and short of it is, this is confirmation to him that the boom part of the clock is in play. I think I have some notes on the right. Right, commodity acceleration. PMIs indicate commodity acceleration. That's what I'm saying there. U.S. dollar peak despite pound not easing. Yeah, so I almost feel like he's saying the rest of the world's going to ease or stimulate or do something, and the U.S. is just going to sit pat, and that will make the dollar ease. I'm not sure how that happens, but I'm long bond, so I think the dollar's going to ease. Positioning might not take much to move the flow. Okay, so we're not there yet. Let's go to that. Trough International. 3P supports cyclical long-term international, cyclical long international, EU, China, EM, equity trade. Positioning is long the U.S. The positioning right now, the first P of the 3Ps, is everyone is long the U.S. versus the rest of the world. There are 1.2 trillion of inflows to U.S. stocks decade to date versus just 0.2 trillion for the rest of the world. So the market is overcrowded long U.S. stocks, is what he's implying there. Policy. Under Trump 2.0, well, what it essentially means is monetary and fiscal easing in 2025 in Europe and China, not in the U.S. That's a solid point, and I hope it happens. Essentially, the rest of the world, for fear of tariffs or for execution of tariffs, is going to have to counter it by easing. Now, he did say that the rest of the world has, that the world in general has peaked in easing. But that's not to say that the BRICS won't ease. It's to say that the West is probably done easing. So it's completely legitimate to say that the rest of the world is going to ease, and that's going to help their markets. While the West, under Trump, really can't do that. You know, if he raises tariffs, if he puts tariffs on things, he is not going to be able to spend more money. I think he's going to get a lot of pushback there. And it depends on what Powell does, right? So let's assume that Powell's not going to do anything unless stocks crash. So Trump will not have his way. The rhinos and Democrats will push back. He won't be able to spend more. And that's if he does the tariffs. If he doesn't do the tariffs, well, Powell doesn't have to ease. What I can't figure out is why he thinks the dollar is going to be weaker given these things that I'm seeing here. All right. Back to Trough International. There's policy. That's Trump. We just said that. Profits. All right. So he's talking about corporate earnings here. Global PMI upswing boosts, quote, mercantilist trading economies, e.g. Germany and China. China aggressively targeting rise in abnormally low China consumption as a percentage of GDP. Chart 10. Let's take a look at that. Okay, that's a nice little chart. We'll leave that up there for a little bit. Okay, so what is he saying here? He's saying, first of all, the PMI upswing, that's manufacturing of raw materials, right? That's people taking raw iron and making it into steel. And that's mercantilist trading economies. Of course, obviously, I'm happy to see him use that word. Examples would be Germany and China. Now, I don't know how Germany is, but China's pretty obvious. Now, China's a manufacturing hub, right? I guess Germany is too, I guess in Europe still. But China's a manufacturing hub, and PMI's turning up is bullish for their economies. And China, on top of that, China will or is aggressively targeting the rise in abnormally low China consumption as a percentage of GDP. Chart 10, we'll look at that in a second. More peaceful geopolitics, negative for U.S. tech and defense. Okay. Positive for oil-dependent Asia and Europe. Best European equity decades were 1950s and 1980s. Decades that began with war and ended with peace. Interesting. Best long international trades. Long China consumer and tech stocks in Japan and EU banks. All right. So if you're going international, for all this stuff here he's saying, if you go international, you buy China consumer stocks and China tech stocks. In Japan and Europe, you buy their banks. There you go. All right, let's take a look at this chart here. It's actually bigger here. All right, Chinese consumption as a share of GDP is abnormally low. GDP per capita, current US dollars, and household consumption as a percentage of GDP. Let's see. Okay, I might be stretching or torturing the concept, but this is kind of like an efficient frontier graph, right? In the top middle to far top right, you have your G7 economies, right? They're in blue, your high income economies. And in the around the bend, right, around the curve on the left where China is and Saudi Arabia are, you have your, in terms of consumption, you have your up and coming economies. Now, and then on the far right, you have India, Brazil, and Mexico. These are your non-consumer economies. So Hong Kong is out there up here with US. I'm not sure why it's this low, but the interesting thing is, here, let's go through this. The US has a high GDP and a high household consumption. Okay? So high GDP, that puts us up here, and big consumer economy, that puts us up here. So we're in the top right-hand quadrant. Okay? Mexico is low GDP, but big consumer spending. All right, so rich and spend a lot on stuff, poor and spend a lot on stuff. All right, so the efficient frontier, I think he's trying to convey here, goes like this. It goes in here. It's like it kind of starts here and goes there. That's your efficient frontier graph. If you're not familiar with them, basically it's you migrate from one area to the other on a line that goes like this. Now, China is really low on its consumption given its GDP. Now, GDP is not high compared to, say, South Korea or even Saudi Arabia, but its consumption is even lower. Saudi Arabia's consumption is is probably spot on. So my guess is he's looking for China to move on this line up here. So as their GDP goes up, their consumption will go up. And that makes a lot of sense because, look, they're manufacturing everything, right? They're manufacturing on all cylinders. So in order to get their GDP up, they've got to start buying their own shit, excuse my French, right? So how much more can they manufacture? Maybe they are going to slow down because of what we've done. But the fact of the matter is, they are in a quadrant that doesn't make sense. And he's saying he's looking for that to move up into this area here, into the high income area. Peak US exceptionalism. US nominal GDP is up an exceptional 50% in the past 5 years, driven by excessive government spending. Right? That's been his contention. The government's been pushing the economy, not the businesses that are in the economy. 7.7 trillion in the past 12 months, chart 11. We'll take a look at that in a second. Immigration accounted for 84% of 3.3 million rise in the US population in 24. AI capex hypercycle projected to hit 0.5 trillion in coming years. US exceptionalism now exceptionally expensive, exceptionally well owned. Outperformance to peak in 25 as excess government spending ends. Immigration reduced. Note border encounters down sharply in Q4 under 300K, chart 12. Okay. This is the paragraph that matters. This is the money shot, so to speak. All right. Here's where he lays out that US exceptionalism is rolling over. Okay. So let me just try and put some verbs in this. The US nominal GDP is up an exceptional 50% in the past 5 years, driven by excessive government spending. Chart 11. All right, so there you go. High immigration, that's kept inflation down and productivity up. And AI capex, meaning there's been a lot of spending on AI. It's been like that's the bubble. The bubble's been fueled by this AI capex cycle. And the hypercycle concept is everyone's spending a lot of money to go to the next level in iterative AI and what have you. So it's projected to hit 0.5 in coming years. Now, why am I talking about that? Because this spending is justified by future revenue projections. Deepseek undermines this. Whether it was only $5 million to make doesn't matter. Whether it was stolen from the US doesn't matter. It exists, it's being dumped on our market, and it will undermine the earnings of our companies. Will our companies be able to make money? Well, that remains to be seen, but let's assume that they can. But now they're making money off of a much bigger capital layout than a Chinese company is. You had to spend $500 billion to make that money. Whereas some guy in a basement in China copied your code, tweaked it, and now he can make the same money for $5. That's the point here. This kills potential for AI. And even if there's nothing wrong with the industry itself, there's nothing wrong with our product itself, it becomes a problem because we spent too much money to get where we've gotten. And we can't compete on price to generate enough revenues to justify the spending. In short, the whole thing is overvalued. All right, that's that there. That's important. He's probably going to come back to that. US exceptionalism is now exceptionally expensive. Yeah, overvalued, right? Exceptionally well owned. Everyone has it, right? Outperformance to peak in 25 as excess government spending ends. Oh my God. My dog is vomiting for dinner. All right. Excess government spending ends, right? Everyone's deficit oriented. You know, you don't want inflation anymore. You can't spend it. Immigration reduced. Labor costs are going. Oh, that's where the chart on the immigration part comes. Yeah. So basically, he's saying we have no immigrants coming in. and that's the end of cheap labor. I just don't see Powell easing again. I know Goldman still thinks he's going to ease again, and he might, but that's, I think, if we have a crash. I don't know that we're going to have a crash. I'd like us to, but anyway. All right. Immigration reduced, note border encounters down sharply in Q4 under 300K, chart 12. And here we go. And Deepseek means peak AI CapEx return expectations are the second wave of inflation, and the second wave of inflation are the biggest threat to the US index. So Deepseek coming in like any manufacturer and saying, I'm the low cost producer of a product, means that the AI CapEx return, the ability to get your money back to UX that you invested, is really going to be hard to do, especially with the second wave of inflation preventing the Fed from easing. So, and that makes US indexes overvalued, US indices. So long as US Treasury yields are range bound and US consumer spending is resilient, peak US exceptionalism relative to not absolute theme, Magnificent Seven, becomes Lagnificent Seven. Supports broadening of US and global equity and credit markets. Okay, all right. So he actually is still saying US markets will be broadening. So it's kind of like saying if you have $100, take $70 out of US stocks, leave $30 that you have in US stocks, put them in cyclical, old economy, and credit type markets. Of that $70, take, remember, he's an equity guy, right? Take 10 and put it in commodities, right? Take 30 and put it in Japan and European financial stocks, and then take the other 30 and put it in, I don't know, China tech, emerging market bonds. I don't know, but you get the idea. That's what he's suggesting. That's it. I mean, he's not saying it, but he's really doubling down on the concept of, hey, let's get out of US stocks here. So, and the last time he did that, he didn't get hurt, but I don't think a lot of people listened to him. You know what I mean? Like, I don't think enough people moved to move their money to move the needle. However, bonds had a nice run up recently. Is it done? I don't know. The dollar is weakening. Nvidia is weakening. Deepseek comes along. Deepseek comes along at a very nice time to make him look very good. And I hope he's right. Let's do a couple screenshots so you can see the actual report. All right. I'm a big fan of the chart 22. I think a theme for him, if he wants to just be all clever and go with those, Gen X pop references. What happens when the streams cross? Like, this is people getting out of T-bills and getting into T-notes. I don't know what's going on down here. So as people roll out further on the curve, this makes him right about his bond assessment. So it's almost like if the blue lines cross, that's bearish for stocks. I'm just making it up. And there's gold is leading year to date. Crypto is ahead of it, but he doesn't include that in his table. I've never seen gold. I mean, we've never seen gold perform since 2000, 2 years in a row at the top. All right, so let's call it 2010, 2011. So maybe we finished number 2. If you go back to the 70s or 80s, I mean, it's hard to believe that gold's doing this well, and it's not an inflationary issue. And it's not an inflationary issue. It's a sovereign issue. Rules of the tools, bull and bear indicator, no help this week. Crypto assets and losers. All right, there you go. I'm Vince. Have a great night.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.